Good morning. Richard Calhoun, real estate broker with Creekside Realty, working with buyers and sellers in Silicon Valley for 40 years. We're here today to talk about the real estate market in Silicon Valley. We're talking about week number 51. The URLs are going to be changing on the new year. The 2021 work for this session, but next week's will be the 2022 URLs. We'll discuss those in a few minutes. First data slide looks at the two major components in any industry, supply and demand. The reason there's three lines is there's two lines for supply. The blue line down at the bottom here is the total inventory. That's what's available in the reservoir. And you can see, just like the drought that we used to be having, there's a drought in the available listings. So the available listings are only about 55% of where you'd expect them to be. And that's in both counties, Santa Clara County, San Mateo County, in both types of properties, single family homes and condo townhouses. So there's a shortage of inventory. The number of new listings coming on the market is the gray line. And you can see, for the most part, that's been right about the yellow line. It's been both sides of the yellow line. It looks like it's roughly the 100% of the average you'd expect. If someone was to say, starting about here in week 39, there was more inventory every week than you would expect, I would actually agree with that. The one exception is Thanksgiving. And the reason for that Thanksgiving over the 5-year median is split between 2 weeks, where in any given year it only happens in 1 week. And so that explains this drop down for Thanksgiving week. But if someone wanted to say the number of new listings coming on the market is slightly above the 5-year median since Labor Day, I would probably agree with that. Then let's look at the red line, the demand line. And long term, that's been somewhere probably around 15-20% above the 5-year, probably not quite 20%. So let's say 15% above the 5-year median. So we've had far more demand than you would expect to have. And it's shooting off the scale here at the end of the year, but I think that's just more the fluctuation of this cycle, which is why one of the reasons I do so much comparison compared to the same time every year. Now what we're looking at is the ratio. I call it days of unsold inventory. This is a theoretical number. It's how quickly would every property on the market sell if no new listings came on the market. It's essentially the turn rate of the industry. And you can see that anything below 40 days is considered by myself to be a red hot seller's marketplace. From 40 to 80 is a neutral balanced marketplace, and above 80 days of unsold inventory is an ice cold blue buyer's marketplace. So where are we? We're basically at record low numbers. We're below 20 days of unsold inventory. Again, that's for the macro data, both counties, both types of properties. And the 5 years that I'm comparing it to are 15 through 19, which are 5 good years. And you can see that number has been somewhere around 40, right on the cusp, until it's shot up. And I think that shoot up will happen next week. Now we're looking at, what are the buyers doing? These are buyers coming in, and how much are they bidding over asking price, the sale price to list price distribution of every week for the last 22 weeks. For every transaction, you just bought it out. So you can see that, 5% of the sellers get less than their asking price, roughly between 15% and somewhere about 20% of the sellers are getting their asking price. So that's about, 15 to 30%. So that's about 15% total. And every week is slightly different, but that's sort of the range. And then basically about 70% of the sellers are getting more than their asking price. You can see the solid lines, the most recent lines, they're towards the upper end of the graph, which says that the market's tending to improve. The purple line is the current line. And the thing that I've been commenting on and noting recently is the shape of the line is pretty unusual and changing sort of recently. I'm not sure why. The past pattern is it's been getting steeper. You can see the purple line and the burnt orange line from last week are basically at the top here, and then they come down, and both, the purple ends up in the middle sooner, the orange ends up in the middle down here, and they're both sort of in the middle. So it's sort of like the rotation of the slope has increased a little bit. But what's also interesting is the shape of the line. The purple line now comes down and it dips down, and then it flattens out, and then it rounds up. It's got like a sine wave going on top of the normal slope. And last week sort of had the same thing, maybe a little closer together. It may just be the lack of data. I think there's only 249 transactions in this whole slide, but you can see the general trend of this line is very constant. But I think that's in the minutia and probably doesn't really make any difference. What it does tell you is down here in the blue dotted line is the worst month data we ever had, which was December of 2001. And then the dotted red line at the top is the best month we ever had, which was April of 2018. So that gives you a realm of the range of this data. And then what you're towards the top part of this data. And anytime you've got this number of people getting over their asking price, it's a strong marketplace. But basically, a few weeks ago, the market was basically fluctuating. I would say probably for about the last 3 to 5 weeks now, the market appears to be getting more robust in the amount of buyer overbidding. Now, it could be the buyers are more desperate. It could be sellers are coming on the market at lower prices. It could be people are bringing in 2022 appreciation into 2021. For whatever reason, the transactions that have closed in the last 3 to 5 weeks, which now means those are transactions that were negotiated 8 to 10 weeks ago, are seeming to have more overbidding than we've been having recently. This table is showing you the different components, the key components in the different micro market areas. So you start off with single family homes in Santa Clara County, then you go to single family homes in San Mateo County, and then you come down to condos and townhouses in both. So we talked about days of unsold inventory. That's the speed of the marketplace. And when you have areas that are in single digit, let alone 3 and 5, that's unbelievable. I also will point out, because it's the first time I remember seeing this, midweek, we went to zero inventory in Foster City and Redwood Shores. There isn't a single family home on the MLS for sale in those two communities. And I've never seen that before. So that's why that's showing up at zero. So these are very low numbers across the board, even in the condos and townhouses. Then if you look at the frequency of overbidding, this is how common is it for sellers to get more than their asking price. And basically you're going from a high of about 94% in Cupertino and Sunnyvale to a low in single family homes of 45%. So it is quite a bit of a range from 45 to 95, a range of 50 percentile. But the bulk of these are 3/4 to 85% roughly. I would say Santa Clara County is a little hotter, a little more frequent overbidding than in San Mateo County. The redder the color, the more frequent the overbidding is. So the intensity of the reds up in Santa Clara County are a little more intense than the reds in San Mateo County. And then in the condos and townhouses, it really drops off because you have a fair number of areas around 60%. So it's noticeably pink, but it's clearly not as hot as the single family home marketplace is. Then the next component is the magnitude of overbidding. How dramatically overbidding are buyers paying? And in Cupertino, Sunnyvale, it's 20% above asking price. The county overall, it's 11%. In South County is sort of the low end at 5%. San Mateo County is a little cooler, especially in the expensive areas. It's actually what I consider to be balanced marketplace. That happens at 101.5%. Here you're at 101.2%. Also want to just throw out, this is the average number, not the median number. The average number is you take them all together and take a strict mean of them. The median is the midpoint, which is a little bit more meaningful typically. But when you're looking at the percent of overbid, if you were anywhere close to a normal marketplace, that percent of overbid would consistently be right around 100% and wouldn't tell you very much information. And that's why I went with the average. But you have to realize that and it depends on the market and everything else, but like for Santa Clara County, the median was around 108%. So the average is 111%, the median is 108. There's an equal number of people at or below 108 as there are above 108%. And then the last column is more almost informational, but it's very useful. It gives you the price range in each of the different micro market areas. So you can see, for example, in South County, you go from 800,000 to 1.8. So 80% of the homes are in that $1 million price range from 800,000 to 1,800,000. And then the median that most people follow is at 1.2 million or so. And that you can see all the different numbers for whatever micro market area you're interested in. And then the condos, and I've commented about this before, they're fairly tightly priced, from 7.75 million to 9/10 or to $1 million. So the bulk of the condos are basically in that $25.25 million range, from $750,000 to $1 million. And the outlying area is the expensive areas, which of Santa Clara County, which are Saratoga, Los Gatos, Cupertino, Sunnyvale, Mountain View, Los Altos, Palo Alto. Those get a little bit more expensive at 1.1 million. And again, I'm not sure I said it, the lower number on the left is the 10 percentile number. So only 10% of the homes are going to be lower than the number here, or in this particular case, 10% of the condos. The middle number is the median, the midpoint, and the upper end is the 90 percentile, which is why I did say that 80% of the homes are between those two numbers. So that's a quick thing. As people get their questions ready, let me explain what's going on with the URLs. We're changing from what you're familiar with, which is going to be valid for today only, and is the old URLs. The new URLs starting next week are going to be SVREMG, which stands for Silicon Valley Real Estate Market Graphs, and then the year. So that's what you use to get to me Saturday morning live. The handout for today's session is posted. So that would be the old URL, REmarketGraphs handout 2021-12-25. The URL starting next week will be Silicon Valley Real Estate Market, and then H for handout. So SVREMGH 2022 for the year, 01 for the month, and then 01 for the day, because that will be next Saturday. And the URL for the archive, the reason I'm not putting last year's up there, last year's works, this one works, but it's going to be teeny URL, Silicon Valley Real Estate Market Graphs, just the letters going forward. And then to get to a specific episode, the 2021 versions, you're going to have to use the old URL for. Going forward, you would use the 2022 URL. So with that, I'll pause and see if there's any questions. Seeing that I have no questions, I will move forward. Now what we're going to do is look at the same data in a little bit more detail with different components. So now this is the raw count. This is showing the number of new listings coming on the market. So you can see that you start off the year, you gain new listings, and then you level off, and then you drop down. And you can see how the blue line and the yellow line are very, very similar. You might argue that up here a little bit, the blue line was a little bit below the yellow line. Then basically from the 20th to the 19th week through about the 39th week, they were basically exactly on top of one another. And if someone was to argue that since Labor Day, since week 39 forward, the blue line is slightly higher than the yellow line, I think that's a reasonable interpretation. So you started off the year at roughly the same levels, potentially a little bit more here, but it's only a short week. Then, by the end of February, you were probably below until probably around the week 20, which is probably Memorial Day. And then from Memorial Day through Labor Day, we had exactly the match. And then from Labor Day forward, we've probably had more new listings coming on the marketplace. But let's look at what level of inventory we've had. So you had more inventory than average starting off at the beginning part of the year. Then quickly you went to average, and then fairly early on, basically starting at week 16, you had less inventory than you normally had, and then that's just falling off as it falls off. So we're basically having record low inventory. We only have 500 listings in both counties with both types of properties. Now you're looking at the number of new offers accepted. This is flipping over and looking at the demand side. The first two slides are both looking at supply. So where's demand? The blue line is the current year data. You can see it's been basically above the yellow line every week except for basically July 4th, Labor Day, and Thanksgiving. And the only reason they're equal on those three occasions, and even back here on July the 4th, is because the holiday happens in only 1 week, where over the 5-year median that I'm basing it on, the impact of the holiday is spread over between 2 years. And so when you concentrate the impact on only one, it's more significant. But basically, the takeaway is the number of new offers and the demand from the buyer side has been outstripping the 5-year median, and the 5-year median 15 through 19 were 5 great years. Now what we're looking at is the days of unsold inventory for the three major components. The three major components are the red line down here, Santa Clara County single family home. Then the brown line is San Mateo County single family homes, and sort of the gold line is Santa Clara County condos. So you can see it over time. You can see that we started off, you have the holiday impact, which is what I expect to start happening. We accelerated, we had COVID announcement, we shot up. As soon as we could start showing houses, we started improving. And then basically from the end of June onward, we did a constant improvement through basically the end of 2020. Then 2021 has been basically this on fire year at basically the same hot levels all year long. Yes, there's some fluctuation from week to week, and this is a 5-week number, so it's a little bit more stable, but it's been pretty flat. And then now going into the end of the year, it's been really dropping down, and that drop down's basically been since October. So it's a little bit more than just the holidays, it's more the whole seasonal impact. But what we're seeing is we're seeing huge demand with no inventory, which is just going to make the days of unsold inventory go particularly low. It's a map of Silicon Valley, and it shows you the DUI. The redder the color, the more lower the DUI is, the more intense the market is. And it's for single family homes only. And so you can see down here in South County, yes, it's clearly red, but it's not as red as the northern Santa Clara County portions. You can see Saratoga Los Gatos is slightly paler than South County. Mountain View, Los Altos is about the same intensity. And you can just see the color difference a little bit in the numbers over here. Palo Alto north up into Menlo Park, Atherton is pure white from 42.5 to 77, and 48 is between those two numbers, because this is the one index where as the number goes up, the market's slowing down. So because it's greater than 42.5, it shows no color whatsoever. It's in a balanced marketplace is basically what I'm saying. And then Foster City actually has 0 listings and is saturated red, but so are all at 5.5, at 3, at 5.3, and 5.1. They're all saturated red. 8 days, it's not quite saturated red, but my eyeballs don't see the difference between these two colors. There's a mathematical difference in the color, so there is some color gradient there, but just looking at it, at least on my screen, I'm not seeing the color with difference in my own eyes. I did run into an interesting issue with Excel, and that is we know we have an extra line here to get the vertical separation. So normally in 2020, you have to subtract 1. So week 53 is actually week 52. But you'll now notice there's a week 54 data. And that's because if I didn't have week 54, Excel would not even plot the dot here for week 53, which is really week 52. So that's why this line's horizontal. It's to give us a mark of where the line is, and you'll notice that throughout the next several slides. So it's only 1 week. It's week 52, labeled week 53. I needed to put in week 54 just to have it show. But you can see the frequency of overbidding this year is up here somewhere around 77%, where last year it was down basically at 50%. So it's quite a bit more common for a seller to get overbidding this year than last year. This is the frequency of the 3 major components. Same color scheme. The red line up at the top is Santa Clara County single family homes. The brown line is San Mateo County single family homes, and the gold line is Santa Clara County condos and townhouses. So you can see, if you go way back to the left side of the graph, you can see that San Mateo and Santa Clara County were right on top of one another. If you go back to the first couple days, San Mateo County was actually more overbidding than Santa Clara County. That is normally where the two counties are in relationship to one another. But once we hit the pandemic, San Mateo County actually came in lower than Santa Clara County. And there does seem to be a shift in favor of Santa Clara County and away from San Mateo County. Now, granted, it isn't that much of a shift, because still, almost 80% of your sellers are getting, and the number might be 75% of your or 78% of your sellers are getting more than their asking price in San Mateo County. And then in Santa Clara County, it's at some number like 82%. So they're both just phenomenal, but the roles have reversed a little bit. This is the micro market area. Again, single family homes only. This is showing you the frequency of the different micro market areas, anywhere from 45 up to 94%. This is showing the magnitude of overbidding. So this is the other thing, how much your buyers are overpaying, not overpaying, overbidding. Overbidding by $100 or $1,000 is a different story than overbidding by $100,000. But you can see right now we're somewhere up here around 110% is the average overbid for both types of properties and both counties. This is the breakdown in the different geographical areas. You can see we go from a low of 101% of the overbid over the seller's asking price to a high of 120% in Cupertino, Sunnyvale. So there is a spread of about 19%. And this is the sale price to list price ratio distribution we discussed earlier. You can see the purple line coming through is the current data, and you can see it sort of it's almost like instead of being a straight line, and it really wasn't a straight line, it should have been a sort of a curved line coming in and then curving back the other way. And now it almost looks like there's a curve on top of curve. So you have a dip down right through here, and then you start returning. So I think that's really the minutia. This purple line has 249 data points. So there's fewer data points than a lot of weeks. A lot of weeks were right around 400. And as you get less data, it becomes more fluctuating. Here you can see the fluctuations. You can see the burnt orange line also fluctuated. But other than that, the lines, other than the last 2 weeks, are fairly well behaved. So I don't think there's any significance to it. And I think the overall takeaway is just that both of the lines are towards the top of where it is. Now, if you look at it, to me, it looks like the November 27th is the line up here that has the highest market overbidding. And then you went down to December the 4th, then you went up to December 11th, then you went up on the burnt orange to this December 18th, and now you're December 25th. So, right here where I'm standing now at basically 45%, the current line, the purple line, is the fourth highest overbidding. But if you come up here, it's basically tied for first place. So there's some fluctuation, but the overall trend is the dotted lines are the oldest, the dashed lines are the next oldest, and then the solid lines are the most recent. The trend, if I read the graph, is sort of upwards. It's really hard to say, but if someone was to say that it's neutral, I would buy that. Actually, I'd feel more comfortable saying it was sort of neutral and bouncing about 3 weeks ago, and the last 5 weeks, something like that, has sort of shown a constant improvement. Wrong way. Here is the sale price distribution of the different areas. And again, you have the 10 percentile number, the median number, and the 90 percentile of each of the different micro market areas. And this is single family homes only, no condos or townhouses. This is the price median only of the three major components. You can see San Mateo County is more expensive than Santa Clara County. You can see we bounce together here pretty closely, so there's some normal noise in the data. This is sort of giving a recap of the major components and where it is compared to the norm, and the norm being 2015 through 2019, which again were 5 great years. So what do we have going on? Well, in active listings, you can talk about the inventory. So the inventory in Santa Clara County single family homes is 34% of what you'd expect it to be. So we only have a third of the homes you would expect. If you go just a little bit north into San Mateo County, they have 54.6%, or just over 50% of the inventory you'd expect. If you flip over and look at condos in Santa Clara County, you're at 3/4, 78.4% of the inventory you expect. If you go up to the Bay Cities in San Mateo County, you actually have more inventory than you'd expect, which is why it's blue in color. If you had 202 times the inventory you'd expect that to be a buyer's marketplace. And the number on the right is just where we were last week. So you can see there's some fluctuation, especially in Santa Clara County condos and townhouses, but that's a lot to do with the holiday and just a lot to do with, fluctuation of 1 week. Then the next thing, to get DUI, you need the number of offers. So this is my indication of how offers you're doing. And last week, for Santa Clara County single family homes, you were at 17. Now you dropped to 10. San Mateo, you were at 20, you dropped to 13. So both counties dropped fairly significantly. Anything, even 20 days is, unbelievably aggressive marketplace. Because again, anything below 40 days is what I consider to be a red hot seller's marketplace. Then if you look at the condos and townhouses, you can see that the market's slower, but in Santa Clara County, you went from 25 days down to 14. And in San Mateo County, in the Bay Cities, you went from 28 days to 20 days. Then if you move on to closings, and what we learned from closings is the sale price. So once you hit the sale price, you can look at the frequency and magnitude of overbidding. So here you can see you went from 81.5% to 80%. Is that a significant change? Not really. Anytime you're at 80% of the sellers getting over their asking price, that's pretty incredible. In San Mateo County, it's at 76%. Condos and townhouses are 2/3 for Santa Clara County, 60%, 6 out of 10 for the Bay Cities. 3 out of 5 sellers are getting more than their asking price. Then if you look at the magnitude of overbidding, Santa Clara County is doing a little bit greater at 111% on single family homes. San Mateo's at 110%. Condos are at 104 and 103% respectively. Then if you look at the appreciation, we have a couple different things. On the right-hand side, instead of last week's data, we have the peak appreciation. So Santa Clara County went up over 2020 prices by 24.8% back on June 29th, and now we're at 20.4%. And that actually got down, I think, to 16.8%. So we went up to 24.8%, came back down to 16.8%, but now we're back up to 20.4%. So that's just some of the overshoot. And now it appears that we're having some appreciation at the end of the year. We had this in 2017, so it's not a 100% unique occurrence, but for it to happen in 2 years is not that common. And it happens when you have strong marketplace. Then if you look at San Mateo County single family homes, it had peaked at basically the same 24.6%. It came down to 15.47. It actually went lower and is recovering a little bit, but hasn't recovered as much as Santa Clara County single family homes. Same thing with the condos, 18.9 to 16.3, a little bit more stable typically in the condo marketplace. The condo marketplace tends to be more a slow, steady increase in pricing, where the single family homes tend to have a more annual fluctuation. And this is actually noteworthy. We had 15.7% appreciation in San Mateo County over 2020 pricing earlier this year, but now we actually have a loss of 7.6%. And, that's all happened since the end of August. So that's a pretty significant change. You've basically lost something like 23% of the market value of the 2020 market value off the peak price of 2021. Here's showing the micro market areas and when they had their peak pricing. If it's in the high column here, it was basically back, and most of these were around the end of June when those two prices happened. The other micro market areas all highlight where the peak pricing happened, and you can having right now in the moderate low areas, which are Blossom Valley, Santa Teresa, North Valley, Milpitas, they're actually at their peak right now at 29.4% appreciation over last year's prices. The week before, you had 3 micro market areas in Santa Clara County hit their peak for the year. So this is, shows you, when you start having the bulk of your county area hitting their peak right now, and the county as a whole isn't at its peak, shows that there's a shift in the micro markets, a shift in where the volume's occurring. And I think I already did this graph, this table on the recap. I normally intend to throw the chart up just to throw it up to let people know it's coming, but since I already talked about it, there's no reason to talk about it again. Here is the current data, and I need to point out this is not a direct apples and apples comparison, because here we're comparing data as of today, December the 25th, data gathered through the 24th at midnight. Normally we're looking at the data on January the 5th. 5th. So we're off by basically almost 2 weeks still, but it gives you an indication of where we're going. And the thing I would like to point out the most is inventory level here at 177. And if you look at that, that's the lowest we ever had. And I expect this number to get even lower. So will it get to be half of 2017? There's a chance that it may, because I only have to get down to 145 to be there. And, and I have to get there by January the 5th. It's going to be somewhat difficult to call, but I would almost say it's going to be half the volume of 2017. Whatever the precise number is, we have record low inventory and phenomenally low inventory. To have only 177 single family homes available in all of Santa Clara County for a population of approximately 2 million people, there's no inventory. The other thing I'll point out, because someone may think what's going on, is the average days on the market is 118. That sounds like a real slow marketplace. How can you explain it? Well, you explain it by the fact that what's on the marketplace isn't selling, and hasn't been selling for a long period of time, and that's why the average days on the market for what's available is a high number. If you drop down and look at what's pending, which is a cross section of what buyers find intriguing, then those numbers drop down to 18, and 18 is a record low number. So that's in offers is where it's more important than on the marketplace. I just do the on the marketplace just to give people some sort of reference and just to be complete. It's sort of the same analogy. There's a consumer out there that likes to argue that this median asking price of 1.975, where the median sale price is only 1.65, he would argue that means that sellers are taking a $325,000 price cut. Absolutely not. They're different properties. What's on the market and selling is a different market mix than what's on the market and not selling. So it's noteworthy to track this, but you can't go from this number down to this number and say values went down. In fact, that shows you can't, because these are both asking prices. So what's on the market, it's got a median price of almost $2 million. A median price, asking price of what's selling is less than 1.5. So there's almost a $500,000 delta in the two numbers, and they're both the same number. It's just that shows you how dramatically different the micro market mix is. Also noteworthy is the number of sales. We're just below 600. This number will drop down pretty dramatically. It could get below, I expect it to get below the 487. I don't know if it will get below the 409 or not. It's too early to tell. It's also the lowest number tends to happen around January 19th, the middle of January, but this data is gathered on the 4th and reported on the 5th of January. So it will not be at the all-time low. And then you have the characteristics of the house. Then you come down to the sale price and you pick up closings. You pick up sale price, and now we look at the magnitude at 111% and the frequency of 80% of overbidding. Then you have the price range of $1 million to $3.5 million, with the median being 1650. I don't believe this is the highest we've been. I believe we've been at a number over 17 already on the median, but not right at the moment. And then you get the number of sales, 921. And finally, we end up with the characteristics of the property. Now, this next table looks very similar, but it is an apples and apples comparison, because I'm comparing November, which is data that was collected on the 5th of November, because I start on the 1st of November and go for 35 days and report it on November the 6th. So that's for people that like to try to be a more direct comparison. I do the other chart and give it a higher priority, because it's sort of telling you where the market's going versus where the market has been. And with that, I'm done pausing for any questions, and I'll explain the URLs again. The green URL is what I call my root URL. Starting in next week, we're going to be changing to tinyurl/SVREMG 2022. That will get you to the live session at Saturday mornings at 9 a.m. You add in the word handout, or the letter H for handout, 2022-01-01, and you'll get the handout for next week. It's not there yet because I don't have the data. I need to wait for the data to actually happen. But for the current date, and it is posted, you put in the old URL, REmarketGraphs handout spelled out 2021 12 25, and you get it. The archived is the new URL or the old one. Both of them will work. That's why I only have the new one here. And then for a specific episode, for any episode in 2021 that aired in 2021, you'll have to use the 2021 URL, which is REmarketGraphs 2021, whatever month and whatever day. And starting next week, you'll start putting in Silicon Valley REMG, so SVREMG, and I have to get used to saying that. It stands for Silicon Valley Real Estate Market Graphs, and then the year, month, date code. Any questions from anybody? Not seeing any questions. I'll call it a day.